Ladies and gentlemen, good day and welcome to the Max Ventures and Industries Q1 and FY2022 investors call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sahil Vachani, Managing Director and CEO, Max Ventures and Industries. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. Thank you for joining us on the Max Ventures and Industries Q1FY22 earnings conference call. Along with me today, we have our CFO, Mr. Nitin Concall, Mr. Rishi Raj, Chief Operating Officer, Mr. Ramneek Jain, CEO of our Packaging Films, and Mr. Rohit Rajput, CEO of Max Asset Services. We're also joined by SGA, our Investor Relations Advisors on the call. Thank you everyone again for joining the call, and I hope you and everyone around you is safe and in good health. Let me start first with the key highlights for the company. We are very pleased to share that we have continued to post record performance in Q1 FY22, clocking the best ever profitability for the company. Quarter 1 FY22 consolidated revenue increased by 49% year-on-year to 384 crores. EBITDA increased by 87% year-on-year to 88 crores. And EBITDA margins expanded by 460 basis points, and PAT increased by 251% on a year-on-year basis to 46 crores. Our specialty packaging films business, Max Specialty Films, recorded its highest ever quarterly revenue, EBITDA and PAT in Q1 FY22 on the back of strong demand accelerated by the shift towards sustainable solutions, recyclable and value-added specialty film products. Our real estate business, housed under Max Estates, lease rental income increased by 88% to 8.3 crores in FY22 on account of higher occupancy at Max Towers. After having significantly leased out Max Towers, our focus currently remains on leasing out Max House, a second development in Delhi in Okhla, which is phase 1 of Max House, and continue the time-bound construction for Max Square. Now let me give you a brief outlook on the business. We believe both our businesses of real estate and packaging films have tremendous growth potential. While our packaging business has already demonstrated robust performance during the last year and will continue to do so, we expect the real estate business to join this bandwagon as new leasing will pick up on account of corporates planning the new offices and as we see the economy unlock. At Max Specialty Films, our efforts over the years focusing on the quality aspects of the business with rolling out value-added specialty films have now started yielding rich results. With our strong R&D team, we develop products which are sustainable and recyclable, adding value to the customers and hence the end consumers. At Max Estates, leasing momentum was impacted due to stringent lockdown restrictions during the first half of Q1 FY22 as a result of the second wave of COVID-19. As the quarter progressed, we witnessed increased inquiries for leasing as the economy started unlocking again. We expect these inquiries and engagement to positively lead to leasing going ahead as restrictions continue to ease and a larger part of the population gets vaccinated. We are also in final stages of evaluating land opportunities for our new commercial as well as residential projects in the National Capital Region, and we expect to announce the same in FY22. We believe the theme of consolidation is very strong in the real estate space, and Max Estates stands at a very interesting position to be able to capitalize on this opportunity as we have demonstrated by curating differentiated experiences that we have delivered at both Max Towers and Max House, through which we have been able to command a premium to the micro market. We believe going ahead, our packaging films business will continue the robust performance with strong focus on sustainable and recyclable products with improving share of value-added specialty films. We expect the commercial real estate business to again take off in the coming months as lockdown restrictions are eased, while foraying into the residential business will allow us to expand our footprint, create future growth opportunities, and further enhance shareholder value. With this, let me hand over now to Rishi Raj, who is our Chief Operating Officer for the real estate business updates. Thank you.
Thank you, Sahil, for the overview. Let me now give you some deeper insights on our real estate business. It is no denying that new leasing in commercial real estate business was once again impacted due to the second wave of COVID-19 pandemic after strongly recovering until the end of FY21. As soon as the offices had gradually started resuming back with increasing attendance, the second wave of COVID-19 forced back corporates to again enforce work from home, which was essential for the safety of each and every one, considering the deadlier second wave. Governments this time around understandably handled it more cautiously and extended the lockdown restrictions until new cases dropped down to a very low level to prevent the spreading of the virus again, which impacted leasing. Having said that, if we look at the industry data for Q1FY22, both on office leasing as well as residential sales, while the outcome was lower on a quarter-to-quarter basis, it fared much better than last year, Q1FY21, indicating resilience of the sector to navigate the business impact much better. Even at Max Estates, we have been able to rebuild the leasing pipeline across all our assets, activating past inquiries and curating new ones as the economy started unlocking from the end of Q1 of this financial year, and the engagements with the prospective tenants continue to increase. We do believe that the future of work will follow a hybrid model, a combination of work from office, work from home, and work from anywhere. In our discussions, many corporates have already started implementing the same, customizing to their context. However, it would be nice to say that there is full clarity on the mix and the new normal. This will evolve, and all industry stakeholders, including us as developers, will need to embrace agility and flexibility in adapting our offering to address the needs and demands of corporate occupiers. Having said that, across all our discussions, it's evidently clear that office is going to be an integral part of the hybrid ecosystem, though the role and the purpose will evolve. We are also witnessing a demand shift from traditional strata-sold offices to a well-managed Grade A office to ensure employee well-being and to enable community collaboration and innovation, roles that offices would need to serve moving forward. In the long term, Grade A office developers like Max Estates are sure to gain on account of this shifting preference. As you know, we at Max Estates ended up doing more leasing in FY21 than we did in the year earlier. And we are very confident that with the recovery in the second half of FY22, which is already being evidenced in inquiries and visits starting July of this year. Let me now give you a brief update on our existing projects. Overall, Max Towers now enjoys an occupancy of more than 90%. Leased area owned by Max Estates in Max Tower is now more than 95% occupied. In terms of leasing area for office spaces, total leased area at Max stands at 4.87 lakh square feet, and leased area owned by Max Estates in Max Tower stands at 2.87 lakh square feet. Lease rental income attributable to Max Estates from Max Tower stands at 7.7 crores in Q1 FY22 versus 4.4 crore last year, up by 75% year on year. In FY22, we expect near full potential lease revenue accruing from Max Towers. Coming to Max House Okhla Phase 1, total leased area here stood at 20,000 square feet, implying an occupancy of approximately 18%. Leasing inquiry for this project has regained post easing of lockdown restrictions, and we expect the project to be leased out in FY22 basis the robust leasing pipeline that we already have now. Work on Max Square project continues to be on track and is expected to be completed by Q4 of financial year 2023 as per our earlier budget. Now, coming to our future development pipeline, we have been evaluating land parcel for our new commercial real estate and initiated it for residential projects as well. We now have a very strong pipeline across different stages, including a few in diligence and advanced stages of commercial negotiations. While the closures has been delayed due to challenges related to COVID-19, particularly Wave 2, we are confident to close these deals and announce these projects in FY22. Residential real estate has witnessed strong green shoots in the last few quarters after a long lull period, with rising preferences for organized developer who has the ability to deliver and execute projects on time with promised ecosystem of amenities. We are more confident now than ever before that this is the right time for us to enter residential segment given the strong brand equity, especially in Delhi NCR region, complemented by a strong balance sheet and access to large institutional capital. We are extremely excited with the way economy as well as the real estate sector is recovering, and thus confident to make Max Estates one of the leading multi-asset class real estate developer in Delhi NCR region in the times to come. Now, let me hand over to Rohit Rajput.
Thank you, Rishi. Let me give brief highlights about Max Asset Services. As Rishi mentioned, the consumer preference is strongly tilting towards two trends: hybrid workspaces and well-managed, experience-driven workspaces. We feel we are well positioned to deliver on both in the near future. Our focus on continuous improvements in our built projects continues, with us receiving the prestigious IGBC WELL Gold certification for our Max House project. I am pleased to report we've submitted our application for IGBC WELL certification for Max Towers and WorkWell Suites and are confident of achieving this prestigious certification across 100% of our office portfolio. We've completed our first milestone towards the British Safety Council certification in 22, assuring our tenants and partners of the highest standards of safety and occupational health in our portfolio. We also launched our Back to Work Well campaign to welcome our tenants back to the office with topical events on mental health, physical health, as well as creation of a meditation zone, basketball facilities, and an open-air cafe at Max Towers, meeting the need for greater amenities that are demanded by tenants today. Going forward, we feel the focus on amenities, certifications promoting wellness, hospitality level experiences, curating unique tenant events, and managing our environmental impact will help us further differentiate through our WorkWell philosophy. For catering to the greater demand for hybrid workspaces, we recently launched our managed office space business under the name WorkWell Suites at Max House. Here, we cater to the corporates who are looking for flexible office space and don't prefer to have a long-term commitment in terms of lease. Here, we have signed up 18 seats during Q1FY22, taking the total signed up seats 28 out of the total 220 available seats. As the economy has started to unlock again, we expect good traction in our managed office space business, driven by demand for flexible office space. Revenue for Max Asset Services increased by 40% year-on-year to 3.4 crores in Q1 FY22 as compared to 2.4 crores in Q1 FY21 on account of higher occupancy at Max Towers. With ramping up of the vaccination drive, we expect the corporates at our projects to resume offices soon, at least with flexible working policies. With resumption of offices, we expect revenue uptick for Max Asset Services as facility services are resumed by the occupiers. Now let me hand over to Mr. Ramneek Jain.
Thank you, Rohit. Q1 FY22 has been an excellent quarter for our packaging films business, recording its highest ever revenue, EBITDA, margins, and PAT on the back of strong demand, increased realization, better product mix, and cost optimization initiatives. MSFL revenue increased by 46% year-over-year to rupees 367.5 crores on the back of increased utilization and higher volume contribution from value-added specialty products. Value-added specialty products contributed 61% to total MSFL volume in Q1 FY22 versus 39% in Q1 FY21. That is an increase of 22 percentage points. Value-added specialty films contributed 68% to total MSFL revenue in Q1 FY22 versus 46% in Q1 FY21. Hence, as a result, EBITDA increased by 76% year-over-year to rupees 81.4 crores, and EBITDA margin expanded by 380 basis points year-over-year to 22.2%. Total volume stood at 15,962 metric ton, which was down 2% year-over-year, but our focus has never been on pushing out more volume, but rather on quality output, which we call as specialty film products. Specialty products are developed after extensive research and efforts by the team, which improve the customer's stickiness, enjoy higher realization, in turn improving the overall profitability of the company. There are also much more sustainable with recyclable properties. Work on the new CPP line has started and expected to be commercialized in Q4 FY22, expanding the company's capacity by 7.2 thousand tons per annum. Second metallizing line is expected to be commercialized in Q3 FY22, enhancing company's specialty product capabilities and hence profitability. Going ahead, we expect the business to continue to perform strongly on the back of strong and sustained demand, increasing contributions from specialty films, and customer shift in preference towards packaged products. All these factors collectively will lead to significant revenue and EBITDA growth in times to come. Thank you. I will now hand over to Nitin Concall, CFO MAXVIL. Over to you, Nitin.
Thanks, Abnik. Good afternoon, everyone. Let me give you the financial highlights for the Q1 FY22. The consolidated revenues increased by 49% year-on-year to rupees 348 crores in Q1 FY22 as compared to rupees 258 crores in Q1 FY21. Consolidated EBITDA increased by 87% year-on-year to 87.6 crores in Q1 FY22 as compared to rupees 47 crores in Q1. Consolidated profit before tax increased by 286% year-on-year to rupees 67.7 crores in Q1 FY22 as compared to rupees 237 crores in Q1 FY21, as compared to 23.7 crores in Q1 FY21. Consolidated PAT increased by 253% year-on-year to rupees 46 crores in Q1 FY22 as compared to rupees 13.1 crores in Q1 FY21. Now let me give you also a brief segmental financial highlights. Our real estate business, that is Max Estates Limited's revenue, more than doubled to rupees 14.3 crores in Q1 FY22 as compared to rupees 4.7 crores in Q1 FY21. Lease rental income increased by 88% year-on-year to rupees 8.3 crores in Q1 FY22 as compared to rupees 4.4 crores in Q1 FY21. This is primarily on account of improved occupancy at Max Stars. Company also was able to sell one residential villa in Dehradun during Q1 FY22 with a total realizable value of rupees 4 crores. Revenue for Max Fit Services increased by 40% year-on-year to rupees 3.4 crores in Q1 FY22 as compared to rupees 2.4 crores in Q1 FY21. Our packaging films vertical MSFL's revenue increased by 46% year-on-year to rupees 367.5 crores in Q1 FY22 as compared to rupees 251 crores in Q1 FY21. EBITDA for the packaging business increased by 76% year-on-year to rupees 81 crores in Q1 as compared to 46 crores in Q1 FY21. Speaking about our liquidity position, gross debt in our real estate business, Max Estates, stood at rupees 176 crores as on June 21. Cash and liquid investments stood at 75 crores. Hence, the net debt on the real estate business stood at rupees 100 crores. Gross debt in our packaging film stood at rupees 326 crores as on June 21. We have used our free cash flows to fund a new capex and will use it to reduce the debt in the packaging business going ahead. Now I will hand over the phone to Indra to open the floors for the Q&A, the question and answer session. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask a question may press star and 1. We'll take our first question from the line of Prashant Sharma from Quantum Securities. Please go ahead.
Yeah, thank you for the opportunity. Sir, my first question is regarding the MAXVIL Phase 1. So in the presentation, it's written that you are in advanced stage of discussion with the client. So is it a one client or many clients, and when we expect that to close?
Hi Prashant, this is Rishi Raj. As far as Max House is concerned, no, it's not one client. We have a very robust pipeline of several clients who are evaluating it for leasing purpose at different stages, including commercial negotiation and diligence on their part. As we have stated, we are very confident to lease out completely by the end of financial year 2022. Of course, subject to vaccination drive, third wave, and any impact that may create. Otherwise, we are very confident given the pipeline that we have.
Okay. And regarding the Dehradun project, how many villas have been sold in this quarter?
So in total, we have 22. Out of that, 18 has been sold and 1 has been sold. Out of 18, 1 has been sold in this quarter.
Okay. Okay. And sir, what is the current occupancy rate of WorkWell?
Yeah, the current occupancy rate of WorkWell is about 15%.
15%. Okay. And this is the last question regarding the new CPP line, sir. Does this have the same, profit margin that we have with the specialty products?
Yeah, this is Ramik. It will eventually be at the same margin. Initially, this is a new product line for us, and as of right now, we feel that it will be a shade below, but very soon we'll catch up.
Okay. Okay. Thank you very much, sir. That's all from my side.
Thank you. Our next question is from the line of Jaikishan Parmar from P3 Green. Please go ahead.
Yeah, thanks. First of all, congratulations for good set of numbers to entire Max team, and thanks for the detailed presentation. Actually, I have 3-4 questions. The first one is related to Max Specialty Film. In the presentation, we have mentioned that will become the most profitable company in the industry. So, if you don't mind, can you share the name of the company which you think is the most profitable, or you can share the profit margins, EBITDA margin of that company, or you think this is the industry best margin which we want to report more than them? That's the first question. And second is on Max Estate side, that by FY22 we are expecting to clock leasing revenue of 30 to 35 crore. So how much of this will flow to the EBITDA margin? And the third question is that I just want to recheck on your real estate business rental side that we have a target to deliver or capture a new or add new project worth around 1 million square feet per year. So by FY24, we can say that you like Max Estate will develop 4 million square feet of project. Of that, approx 50% will be Max Estate. So yeah, these are the three questions, sir. Is it that like that target is still on for real estate business? That's the question.
Yeah, we will take it one by one. Maybe Ramneet can start with the Max Specialty Film.
Yeah, yes.
So, Kishan, you asked a lot of interesting questions on the packaging film business.
Yeah.
Let me just put it this way: while there are no specific numbers to share with you or names, in terms of the internal benchmark we created for ourselves, I think we have passed that over the past couple of quarters. That gives us a lot of confidence. In terms of which company do we idealize, I think we are looking at more global layout of the industry now. In terms of the volume game, as we said, we are more in the specialty side. So one is the absolute number, which is not probably the goal. In terms of the percentages, as you have seen, we have moved significantly over the past 8-10 quarters. I think the benchmarks we are creating for ourselves in this segment. It's difficult to compare one company to the other, but nonetheless, I think the margins where we are, we should definitely hold, and the company is geared for a stronger growth in the coming times. There is strong actions on all fronts, as I said, on the product side, on the internal cost side, on the expansion side. So I think also with the recyclability initiative, it's hard for me to put a number out there, but I think we feel confident of our growth track in the coming months.
So can we at least say that we will be the best like profitable company in listed space, like whatever listed companies you have comparable in the this Max Specialty business, or it will be difficult?
You're encouraging me to reach the feet, and I hope I can live up to your expectation. Thank you.
Okay, thanks, sir.
Okay, so Nitin, for the second one.
Yes, there you asked about what kind of EBIT margins we can expect coming on the revenue. So in the current quarter, we have done EBIT margins of close to 51% going forward in the quarter, and we expect going forward by the end of the year, we would be expecting a number more closer to 60% for the remaining 3 quarters. This is subject to, obviously, we are able to achieve our leasing subject to COVID wave 3 and other factors.
You're telling you're giving EBIT number, right? EBIT of 60% for next
EBIT numbers.
Okay. Thanks, sir.
And Jay, excellent question. So on your third one related to real estate business scale, just to recap, if you look at today between Max Towers, Max House, and Max Square, which is under construction, look at total development portfolio is around 1.5 million square feet. Now, we have already shared that we bid for Delhi 1, which is currently going through the NCLT approval process, which is in the range of 2.5 to 3 million square feet. And we are evaluating several projects, particularly in Gurgaon, for us to announce one this year, approximately 1 million square feet, and continue with that journey year on year. So yes, by FY24, if you look at our development portfolio on a total basis, delivered and under construction would be 4 million plus.
Okay. And if you allow me, last question, that if you can give some similar guidance on residential space.
Yeah, on residential space as well, our stated strategy and goal is to add 0.5 to 1 million square feet every year, starting one that we are evaluating for this year as well.
Yeah, thank you. Thanks. If I have any more questions, I will come in the queue, sir. Thanks.
Sure. Thank you.
Thank you. Our next question is from the line of Ullas Paymaster, an individual investor. Please go ahead.
Yeah, I've got three questions. One is, what is the rental income expected on your Max House project based on whatever lease agreements you have signed? And what is the total investment on that project? Basically, I would like to know what is the return on investment on your own funds you are expecting from this project. The second question is that you have been talking about acquiring land since last 1.5 to 2 years, but no progress has been made. And during this period, I'm sure the property prices must have gone up. So could you explain what are the reasons for the very slow progress in achieving or closing any deal for buying the land? And my third question is on the specialty film business. I have got one basic question. I'm not sure whether it may sound a little bit silly, but the recyclability of the product, how does it affect the overall demand and growth of the film business in future? Thank you.
Thank you, Ullas. We will take your question one by one. Again, excellent question. I will request Nitin to talk about your first and second, which is rental income from Max House and yield to cost return on investment from that project.
So Ullas, what is happening for Max House, we are expecting, currently basis the signed agreements, we are expecting revenues of close to 3.5 crore rupees coming from Max House Phase 1. And on a fully blown on basis, we expect lease rental income of close to 15 to 20 crores coming out from Max House. And in terms of yield to cost, we have deployed a total capital of close to 140 crores on Block A. We expect the returns to be in the range of teens yield to cost on the project at Max House Block A. I will ask Rishi to answer your second question.
Okay, so Ullas, on your question regarding growth, on commercial real estate particularly, we do acknowledge we are running behind what we ideally would have liked in terms of signing a new opportunity. There has been significant disconnect between rental outlook and FSI price expectations from landowners, particularly in Gurgaon, resulting into almost no deals on commercial side in the micro markets we have been evaluating. And as we had discussed in the past as well, we want to judiciously use shareholders' capital. Having said that, I'm really happy and delighted to share that over last couple of quarters, we have curated a few opportunities, primarily in Gurgaon, including a couple now in due diligence and advanced stages of commercial negotiation. So there is some credible progress, and we are confident to get back to you and everybody with the details as we close at least one of these in this financial year.
If I can just supplement to that, what Rishi has said, if we go on slide number 32 of our investor presentation, we have given a pipeline of close to 6 properties which are in the various stages of evaluation, which have a total area of close to 7 million square feet which are getting evaluated. And we are hopeful that in the coming quarters, we would be able to close those transactions, one of those transactions.
Okay, and then I think there was another question from Ullas
Yes.
regarding Max Specialty Film. Ramini, can you take that?
Yes. So, Ullas, again, I really want to compliment you asking the question on how does recyclability and the product help with the recyclability of the business growth. In fact, not many people understand really, but really glad that you asked the question. So we are into polypropylene, and then there is polyester and other products. Basically, when you have a product which is only which is having only one chemical or polymer type, which is either polyester or polypropylene, then post consumer usage, it can be collected and then recycled and tried to merge back into the virgin raw material. In case the two products are mixed, polyester and polypropylene, which is the current prevailing standards in the country, it's very hard to separate them and then it can be neither used as a polyester or a polypropylene. It cannot be used together as a new or a recycled product. So most of the companies are working on using a single family product. Having said that, the reason polyester and polypropylene come together is because they bring different skill sets or different properties and performance standards to the product. Interestingly, what polyester could do is now also being able to be done by polypropylene, but not the other way around. Globally outside India, the product structure is, in any case, polypropylene based, and that trend with the recyclability focus is coming into India, and that is why we have been saying that the move in India is towards a higher demand on polypropylene, where we have been manufacturing only polypropylene for past 3 decades. With that said, propylene, how to move in an effort to replace polyester, and also aluminum, which is a cable which gets added into the structure. So we have products which are capable of eliminating aluminum as well as polyester, which have been developed and deployed in large volumes, which we call specialty products, with respectable brands, multiple brands and multiple applications over the past 2 years. That has taken traction as our recognition of a company which has strong products and technology, and with the increasing demand on recyclability and performance specs and cost pressures of changing. Well, so the first question, how does recyclability and product help having a more family structure of polypropylene can do what polyester cannot. With that said, our products have taken traction, and with the increasing demand, and not only in base polypropylene, but higher, I think we are continuing to gain margin. Thank you.
Okay, I'll come back later. I've got one more question. I'll come back later. Thank you.
Thank you. Before we take our next question, we would like to remind participants to ask a question. You may enter star and 1. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. I joined a little late, so I don't know if these questions have already heard. I wanted to know what is the return on equity or return on net worth that you expect in the real estate business. And second is, what is the rental that we have realized in the first quarter? Hello.
Hello. Yeah, Tushar. So, Tushar, what is happening? There are 2 parts to it. One is the return on equity and return on net worth. So, going forward, we expect to have these numbers in high teens. But in the real estate space, the intrinsic value of the assets also play a significant role in the way we look at the assets. In the current quarter, if I talk about the rental income which we have realized is close to 7.3 crores, which has got realized in the current quarter.
No, so on a per square feet basis, how much does that work out to per month, per square feet per month?
So what is happening, we have got 2 projects which are running as of now, which are under lease. One is the Max Towers, in which we have a lease rental which is in excess of which is close to 105 rupees per square feet per month. This is excluding the maintenance charges. And the second project which we are doing is Max House, in which the number is currently at 120 rupees plus per square feet per month, plus maintenance on top of that.
So you are saying income is 7.3 or 7.7, right? So that's per month 2.5 crores, right?
Yes.
But your lease area is much more. It's some 6-7 lakh square feet. So I'm not able to get the maths, that's why I just want a little clarity on that.
3 lakh square feet of space which is leased at Max Towers, and close to 20,000 square feet of space which is leased at Max House. But in terms of what happens, there are certain the numbers which get progressively built up. There are certain rent frees which are given as a part of the commercial deal. So as we go forward, these numbers will start showing improvements.
So based on current leasing, do we expect 7-8 crores a month run rate?
So yeah, we expect this number to be, what expectation is close to 30 to 35 crores annual rental coming from leasing.
30 to 35 crores. Okay. Yeah. And on the return on equity in the real estate business, I understand what you're saying in terms of asset value, but many times the cost of borrowing is higher than the rental yield. So, what is our game plan? Are we planning to do a REIT? How do we extract the value which is there in the asset? Because once the asset stabilizes, then really it is, diluting our equity returns. So I wanted to understand your game plan in the longer term, medium term kind of a thing.
So Tushar, there are two parts to this journey. The part one, we did Max Towers, in which we were establishing a brand, and we had to make significant investments for the complete development of this Max Towers, which resulted in our yield to cost coming close to 8%. But going forward, the project which we are looking at, something like a Max Square, we will have a yield to cost which would be close to teens, 14, 15%. So subsequently, when we lever the project, we would have a benefit coming in the equity IRR for the project. So this is how the plan is going forward. We underwrite projects which have a yield to cost of 13 to 14% and which significantly increase the return on equity.
Okay, that's good to know. I understand, first project you have to establish the brand name. Okay, in the longer term, what is your strategy? Are you going to be commercial real estate focused, or are you going to be residential? And how do you look at the cash flows of the real estate business? What kind of development you will do every year?
Yeah, so I'll take that. As a strategy, our stated strategy is one region, multiple asset class. So as a part of that strategy, we began the journey to build commercial office vertical in Delhi NCR. And in the last call, we decided, given the trend and the green shoots in residential sector, we decided to diversify and now also enter into residential asset class. So in summary, at least in the near to mid-term future, our focus is going to be commercial real estate, residential real estate in NCR, and some adjacent play in commercial office, like we have already announced and launched managed office space under the brand WorkWell Suite. So that's our strategy. Now, your second question, just please repeat. Is it to do with you want
in terms of cash flows? How much money will you invest every year in real estate, or how much square feet of development will you do? So because your EBITDA will really depend on what development you do, right? Given that if I were to build a model and I say, okay, you do 1 million square feet a year, or 2 million square feet a year, or 3 million, then one can build some kind of valuation model. So I'm asking from that point of view.
Absolutely, and an excellent question. I think as we earlier stated as well, on an average, our aspiration is to do around 1 million square feet in commercial and in residential every year moving forward. If we just step back, today on a gross basis, we have 1.5 million square feet of commercial development portfolio, including Max Square under construction. We have already bid for and have been awarded as a successful resolution applicant for Delhi 1, which gives you an exposure for 2.5 to 3 million, currently under the court process for approval. And moving forward, around 1 million in commercial, around 0.5 to 1 million in residential is what we are going to target. Now, real estate being a bit of a lumpy business, this is what we want to do on an average as you plan and model your mid to long term cash flow scenario.
Okay, thanks for a very detailed answer.
Thank you. Our next question is from the line of Ashwin Agarwal from Akash Ganga Investments.
Hello. This is Drashti from Ashwin Agarwal's office. Am I audible? Hello.
You are, ma'am. Please proceed.
Hello.
We can hear you, ma'am. Please go ahead with your question.
Thank you for the opportunity. Congratulations on the good set of numbers, especially from the Max Specialty Film segment. So my question was regarding the same segment, considering the amount of debt, like almost which is at 326 crores gross debt. What can be the gross debt for the year end? Like how much can we reduce considering the good performance in the segment?
Nitin?
Yeah. So what we are expecting is to reduce the debt close to 75 to 100 crores in the coming financial year.
Okay, that's it. That was my question. Thank you.
Thank you. We'll take a next question from the line of Ronak Jain from Jain Capital. Please go ahead.
Hi, good afternoon. I have a few questions. Firstly, can you give us the update on what is happening on Delhi 1 project under NCLT?
Yeah, hi Ronak, this is Rishi. Delhi 1, just again as a quick recap, we were awarded as a successful resolution applicant. Post that matter went to NCLT for approval. Because of COVID wave 1 and COVID wave 2, court hearing has been going extremely slowly. As we stand today, the hearings have restarted and we are hopeful to see some progress in next 3 to 6 months. However, it is very difficult to predict with certainty the timelines of the court process. But the good news is that the hearings have started.
Okay. Secondly, on the residential side, will you be focusing on Delhi NCR only, or will be moving to other parts of India as well?
No, as a part of our stated strategy, again, one region, multiple class in near to mid-term, we will right now focus only on Delhi NCR, given the local and the micro nature of the game. More specifically, within Delhi NCR, we have very carefully studied, identified a few micro markets and pockets, including pockets like Golf Course Extension, Southern Periphery Road, Dwarka Expressway, Noida Expressway, including Sector 150, for residential, where we have already activated the intermediaries to help us, both intermediaries, banks, and direct discussions with the landowners. And when we come back in the next quarter, as we have presented to you the pipeline for commercial, we will also present to you the pipeline for residential.
All right. Lastly, would you be planning any equity fundraise in order to fund all this future commercial and residential development?
No, we are not planning to do any equity fundraise at the entity level. What we might evaluate is that to raise capital at the project level, and the same way with what we have done at our project at MAXVIL, in which we have partnered with New York Life, and where they have taken a 49% equity in the project.
Okay, that's helpful. That's all from my side. Thank you.
Thank you. A reminder to a participant, to ask a question, you may enter star and 1. Our next question is a follow-up from Ullas Pemasa, an individual investor. Please go ahead.
Yeah, I think whatever figures which you have given on the return on investment on equity, the figures don't look attractive. I'm sure that you have sound fundamentals to justify the amount of money into the real estate business, because even if you look at the Max House figures, they are not very attractive. I thought that the brand has already been established and you should be able to command a higher rental income from your Max House project. So that is my only worry. If at all, if you have any answers on that, it's fine. Otherwise, whatever you have given with the earlier speaker, that should be okay.
Mr. Pemasa, so what is happening is, as I mentioned earlier also, our strategy in phase 1 was to establish our brand. And what we established in Max Towers was the yield to cost is less as compared to what are typically a project which we will underwrite. And I think the project to benchmark would be Max Square. If I can share with you very broad numbers on that, we are deploying a capital of close to 400 crores. And the rental yield expectation from that project is more in the range of 16 to 17%, close to 70 crores of rental coming from that project. So going forward, the normal benchmark for us would be more in line with teens and underwriting the project on teens. And even for the Max House project going forward, what we will have, it has to be seen jointly. We have got two phases of Max House, Block 1 and Block 2. The Block 2 is expected to be starting now, and we expect the combined yield to pass the litmus at which we underwrite the project.
What is that? What is that percentage you have in mind?
So we would like to have an yield to cost which would be in the range of teens, 13 to 14%, and an equity IRR on the project which would be on high teens mode.
Okay, thank you.
Thank you. Our next question is from the line of Jaikishan Parmar from P3 Green. Please go ahead.
Yeah, thanks for giving opportunity again. I just need if you can give some update on Azure Hospitality, like FY21 revenue or last quarter revenue, or some qualitative metrics on Azure. And second is for Max Square, that project will get ready in Q4 FY23. And so for that, you are like the rental will be front-ended or back-ended? I mean, once the project will develop and then you will search, or you have started process, or you will start much before? And third question is that 1 million target a year, does that include Delhi one also? That's three questions.
Hi, Jaikishan, this is Rohit here.
Yeah, okay.
Let me give you an update on Azure. So, as you know, across the country, all hospitality, F&B businesses are impacted by restrictions on dine-in, and particularly the April, May, June quarter operationally did not give a lot of open days to the business. However, in terms of footfalls and in terms of revenue, the July numbers for Azure have been encouraging. They've recovered nearly 90% of their peak revenue with fewer available seats for dining in and at a lower occupancy. So I think the restaurant sector will be impacted by COVID restrictions in the near term. However, the company has taken strong operational steps to try and lessen the impact of that. We will continue to monitor the investment and continue to look at how we can derive value from it.
Okay. No, if you can give revenue of FY20, that's also fine, because just recently one of the hospitality sector got listed and they are getting good valuation. So get just a sense of what valuation Azure can get on that perspective. If you can give FY20 number, that's also fine, revenue.
Yeah, so FY20, I would say at a ballpark, the business was doing about 130 crores per annum.
Okay.
And yeah.
So, Jay, just to supplement what Rohit said, they have been able to achieve close to 90% of their peak revenue pre-COVID. But what they have done during this phase is they have been very aggressive in negotiating with their landlords in terms of revenue shares, moving from a minimum guaranteed revenue share, and also rationalizing their expenses.
Okay.
So what we expect is, even if at the current juncture itself, they have seen a significant increase in their EBITDA margins. And going forward, as this lockdown wanes away and we get people coming back to life, they will emerge much more stronger post this challenge.
Okay, so this is Rishi. I'll take your second and third question, Jay.
Yeah.
Second question is around Max Square rental search. Just to give you a bit of insight into if you look at life cycle of any office building.
Okay.
The active pre-leasing effort starts 6 to 9 months to the completion. And if you look at, and just to give you an update on where we are and what we are planning to do in that context, while our soft search and engagements have already started through IPCs and direct discussions with client, we are right now finalizing all our collateral, and a much more active and a visible search will starting October of this year. So our plan really is by the time building is ready, we would like to target some amount of pre-leasing, and then over 18 to 24 months aim to complete the 100% leasing of the building. So that's on Max Square. On your question regarding the pipeline, we are evaluating Delhi 1, as I said, is in the court for approval. In parallel to Delhi 1, we are evaluating other opportunities on commercial as well as on residential. When I said 1 million square feet each, this is being done in parallel to Delhi 1.
Yeah, so just to supplement that, what happens is, in our view, our journey is can't be held hostage by Delhi 1 resolution plan. So Delhi 1 happens, great for us, but parallel to us, 1 million is in addition to Delhi 1, which we are looking at.
Okay. Yeah, thanks for all the good detailed answer, and for other participants also, we got good sense. Thank you for a good detailed answer.
Thank you. Our next question is from the line of Jigar Shroff from Financial Research. Please go ahead.
Yeah, thank you for taking my questions, and congratulations on a very good set of numbers. I have 3-4 questions. First question, sir, if you could give some color on our tie-up with Topan in terms of how is it helping us in terms of expanding our global reach or in terms of technical capabilities. And should I ask the other questions?
Yeah.
Yes, please go ahead.
Yeah, and so should we anticipate once the expansion on the packaging lines are completed, the packaging division could have a turnover of approximately 2,000 crores by FY23? That is my second question. And third question, sir, I think you did mention, right? I just wanted to reiterate that by FY24, you're expecting rental income to be about 150 to 150 crores per annum.
I'm sorry to interrupt, Mr. Shroff. Your voice is breaking up, sir. If you're on a hands-free, please switch it to handset and speak.
I'm on hands-free.
Hello. Can you please repeat the question? We were not able to.
The last question particularly.
The last question, sir, the perennial question which we've been always asking. So when do you intend looking at splitting the company value creation for shareholders?
So we'll go one by one. I would request Ramnik if you can answer the first question and
Yes. Right. So with regards to Topan, I think our engagement is increasing with every passing year and every quarter actually. There is a lot of activity which I cannot describe in details with regards to the product development and exploration. Testing which is required level of time in different geographies of the world. So overall, the direction of engagement is much stronger now. In fact, there is a dedicated team they have created at their end in Japan to work specifically on some of these ongoing projects because it is being mutually beneficial to both sides. So I think there is some result on, and also the activity which is in the pipeline, which is ongoing. I think it's very encouraging.
Sorry, can I interrupt, sir? So in terms of engagement, in terms of product development and increasing geographical spread, so what would be the exports, I mean, as a percentage of the turnover at this point of time?
The company's export is in the range of about 25 to 30%. MSFL's percentage export, yes.
And you expect this to scale up to?
Well, it's a very balancing act because there is very strong demand from domestic and also international. So we are actively looking to increase our specialty sales, specialty products. So many of the products which have taken traction in India, now those brands are taking them outside India. and that is helping us to propagate some of it. So again, the mix and geography which helps us maximize our earnings is what we're carefully balancing along with the long-term strategy.
So which countries would we be exporting to, sir? Areas?
We export to more than 100 countries today. Big chunks in Europe and US and Southeast Asia, Middle East as well. In fact, products are going to Japan, Australia, Latin America is including Africa. So it's going all over. The big chunks from Europe and US and Middle East.
And the margins are better in the domestic market?
Well, I would say it's very healthy, and we keep balancing with regards to strategy and seeding the product. But as you can see, overall contribution is helping, and for sure, if we get better margins in India, we shift our quantity there.
Just to add to that, what happens is it's a function of what are you able to sell where. If in India we're able to sell more of a value-added films, which promotes our margins, we will prefer, as Ramik mentioned, we would prefer to sell more domestic rather than exports. So just a value maximization strategy for us, where we are able to sell, we can expect to generate more margins. We prefer to focus on that.
Okay. And so the second question, can we say a turnover at the end of FY23 in the packaging?
So therefore, us not to give us a forward guidance on numbers, we don't prefer to do that. But we expect the numbers to improve. Currently, in addition to our BOPP lines which we are running, we have also announced 2 metalizer lines and 1 CPP. We expect all these 3 lines to be operational by by FY23. And there would be a significant jump up in the revenue, but to give a specific guidance on revenue would not be possible for us.
So the capacity would be enhanced by how much?
So as we shared, the CPP line, the metallizers are going to offer us to value add more on our existing capacity. The CPP line will bring in about 7,000 tons per year. So given our existing capacity, that could be another about 10%. I think the bigger chunk will come. I think we are really looking to be in the specialty zone, and so what we're definitely focusing on is our earnings.
Because the first quarter, when you need to analyze approximately 1,400-1,500 crores. After the capacity is coming into play, it is possible, right? With bringing forward guidance.
I'm really sorry, I could not hear clearly what you said, so if you could repeat, please.
Yeah, the first, if you analyze the revenue, it comes to approximately 1,400-1,500 crores, sir, of the packaging film. So once the entire capex is completed, 2,000 crore turnovers should not be difficult to achieve, sir. Am I right in thinking on those lines, sir?
So making my difficult by saying this in front of my boss, but I think I'll be a little careful saying that, because again, it's again the focus on the it's a challenging target.
What could be the risks to these margins? You've said that 22% is sustainable. The risk could be.
I'm sorry, I did not say that there is a risk to the margin. Of course, it's challenging. Maybe I didn't get it right. I was responding to your target of a 2,000 crore top line.
No. I am the separate question. 20%, you did say that's sustainable. But what would be the risk to not achieve it?
I'm sorry, I did not catch that right. But I think what you're probably saying is the risk to our profit, our EBITDA.
Exactly.
I think it's a balancing act. We always respect the competition. There is healthy competition, and then healthy demand also coming in. I think what has shown and demonstrated and given us good confidence, the traction our new products have taken over the past time, and there are some new strong products, in the early part of the product life cycle stages. So that's how it has been timed to be. I think it's a healthy mix. I feel, as I said, we remain very confident of our product line.
Thank you, Ramneet. Sahil here. And to answer your last question, Jigar, in terms of the potential demerger, I think we as shareholders have always, and as management have always done what's the most value creative for our shareholders. As a group, we will continue to do that. Not able to comment on any demerger plans yet, but as we see the scale and the right opportunity, and if it's in the interest of shareholders, we will definitely do what is required. Thank you.
Okay. Thank you.
Thank you. Our next question is from the line of Hitesh Sharma from White Sky. Please go ahead.
Yeah, my question was similar what you answered just now. We wanted to know like any plans for separating the two business, real estate and packaging.
Thank you. I believe I just answered that question. So, yeah, I think that's it. Thank you.
Yeah.
Thank you. Anyone who has a question may press star and 1. As there are no further questions from the participants, I now hand the floor back to Mr. Sahil Vachani for closing comments. Over to you, sir.
Thank you very much to all our shareholders and investors. We look forward to engaging again with you at the end of the next quarter. Stay safe and be well. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of Max Ventures and Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.